So we sold it this year. That's a good chunk, 5 million profit for the investors. 70% went to them, 30% came to us. Then we just sold Princeton Park, also another asset in Florida. We were really happy. We bought it in COVID, actually, just before COVID, to be truthful. And that was 2019, December. And we sold that this year also. And we won the case with our Austin deal. With we have $4 million in the escrow, non-refundable. So that was very exciting. But you're right. The key thing is everybody. We should diversify. I always say that. Do a little bit here, a little bit there, a little bit here. Put some in startups, put in stocks, mutual funds, EFTs, some, a lot of things are happening. But real estate is something you got to keep money in real estate because it's the leverage game. See, most of the other investments, you have to pay 100% to own them. But in real estate, the bank comes along, or the institution, or Fannie or Freddie comes along. They give you 70% of the loan, or let's say 65% of the loan with the LTV, and you bring 35%. But you are actually controlling the whole 100%. When you sell it, well, we got to look at the real estate which is cash flowing. As you and I were talking before this, we started recording. People call me and they say, Vinny, should I buy this? The cap rate is 3.2, or cap rate is 4.5, or cap rate is 6.5, or 12. I just say, what's the cash flow? The net cash flow after getting all the revenues and all the expenses, you come with the net operating income minus the capex and minus the mortgage payment and so forth, is the net income. So net income, net cash flow is king. We
So
should be, yeah,
you're
we should.
getting at a point because I want to make sure everybody who's listening is grasping what this is. Cap rates are a function of identifying how much your property is worth.
What?
So
Yes.
for any investors not familiar with cap rates, you take the NOI and you divide that by the purchase price, or
Yep.
you could take
Hmm.
the NOI and divide that by a cap rate, and it gives you an ideal purchase price depending upon your investment strategy. What I've heard is you buy at a 10, sell at a 6. So you have this big arbitrage of profit in between that. That was, I believe, Dave Lindahl says it, and there's other people who
Hmm.
said that over the years. So for what Vinny's saying right now is the increments of income are far more important than the surges.
Yeah.
But if you get good increments, if you buy the property for cash flow and then you do your value add and you do all your improvements, the surges are
That's
inevitable. They're an inevitable component to it. Vinny, you wouldn't invest in something that wouldn't offer a surge, right? You wouldn't invest in something that there was no value
exactly.
add, that there was no opportunity to increase. Can we talk about
Won't
that for a
touch it.
moment?
Won't touch it. Will not touch it, brother. Because the key thing is when we are pulling money together of the like-minded people, what I do, right? These are the people who really want, they don't have time or energy, but they have money, accredited investors. They want to, like-minded people, when they join hands, you're able to pool the money together legally, and then you can buy larger assets like 12.5 million asset in Tennessee that we bought. We were able to raise money. We call it raising money, collecting everybody's money, and then they become limited partners in the deal.